and thank you for joining us. Great to see that many of you here are available on YouTube. That's great. So I am Alexandra, as I said, and I'll be hosting today's events with George.
Hi.
We're joined by Gerald Maestu, founder and associate director at Coéos Patrimoine Conseil et Finance. He'll discuss why markets seem to have become disconnected from what's going on in the real economy. So I'll let you, Gerald, present yourself for a second.
Thank you. Well, thank you, first of all, for allowing me to be here with you today. So as you said, I've created a financial advisory firm a few years back. I've been in the financial markets for about 30 years now, with some entrepreneurship, experiments along the way. But I started my career on Wall Street, trading interest rate swaps, and graduated from New York University and ESSEC Business School in Paris. So that's pretty much who I am, and we are based in Valborg in the south of France.
All right. Can we say something really funny about Wall Street? Because not everybody.
Something funny about Wall Street? I don't think anything is funny about Wall Street right now. That's the funny thing. But anyway, if you've seen that movie, the Wolf of Wall Street, that was pretty much, what was going on back then in the late 90s.
Wow. Okay. Won't get into details about this now, but
I was told to be politically correct, so I'll stop right there.
All right. So let's start then with the first question.
Sure. Yeah.
That's not really an easy question, but then again, it's the subject of today's event. Give us a general sense of what is the real economy versus the market economy.
Sure.
Maybe a thorough explanation about that.
Well, to start with, let me comment on your first comment, which was that it's not an easy question. As I said offline and just before we started, obviously the subject of today's intervention is impossible to answer. I wish I had the answer. If I had the answer, I wouldn't give it to you, obviously. I would be somewhere on a beautiful sand beach and, going about my beautiful life. So it's almost an impossible question to ask. I think what we can try to accomplish today is to give some background, to get some avenues and some thoughts, so we can try to understand what's happening. As far as knowing what's going to happen now in the future or at any point in time, obviously, I don't know. So now to get back to your question, what's the real economy and what's the market economy? That it's obviously a very simple answer. What's the real economy? The real economy is you, me, any company, any enterprises going out there, trying to add value while doing their business, whatever business it is, if it's an industry, if it's a commerce, if it's a service industry. So the real economy is, using funds, using assets, and try to increase the value of these funds, trying to increase the value of these assets. So after you go through the creation of what it is the business is doing, then you have a bigger wealth, a bigger assets at the end of the day. That's what a business is. I try to make it as simple as possible. What's an enterprise? What's a business? Basically, it's a box. In that box, you're going to put assets, whatever it is, money, machinery, obviously humans, capital. Something is going to happen in that box. And at the end of whatever cycle, whatever comes out, the output, the idea that the output is obviously of greater value than whatever input it is we put in. That's the real economy. It makes it pretty simple. What's the market economy? So the market economy, technically, and if you go back to your earlier business school, obviously my business school was 30 years ago, but I think it's pretty much the same thing. If you go to your business school, what the market economy is, at some point, it should be the reflection of what the real economy is. In other words, when you invest in a particular company, what you invest in a particular stock, at some point, logic commands that the value of the stock should reflect the value of the company that you're buying into. That's what it is. Obviously, there's a discrepancy between the two, and which is the subject of today's. And I guess what we can start by saying is that the reason why there's a discrepancy is because the market has a tendency to anticipate what will happen within any particular company that I like to invest into. So instead of having a today's picture of what the company is doing, I'm going to be discounting in the next 2, 3, 4, 5 years, whatever that company is going to be doing. So as a whole, the market should be a discounted value of what the economy, what the real economy should be in the next 3 to 5 years. To me, that's what the difference should be. Again, as you may notice, I say a lot of should, could, would, because obviously that's not what's happening in the real world. But yeah, the fundamental, and I know that one of the participants is a professor of economy, so I want to say hi to him, and hopefully I'm not saying anything too stupid, but the difference between the real economy and the market economy is basically a problem of discounted of time between what's happening now in the economy and what should happen in the next 3 to 5 years.
Yeah, have we seen a change in that relationship between the economy and the markets? Like what's happening now that perhaps wasn't happening before?
Well, many things is happening. Well, obviously we're going to talk about what happened last year with the COVID and the reaction of those things. What's happening, but if we were to take away the COVID situation, and I know that we're going to talk about that, but if we were to take away that the particularity of the COVID situation, what's been happening in the last, I'd say 5 to 8 years, is the belief that value has no longer an importance. I'm talking about the marketplace. The ultimate investor is Warren Buffett. And Warren Buffett always said that he would only invest in a company that he understands, and he would only invest in a company that is capable of making profits. What good is it to invest in a company that's not capable of making any money? All right. Yep. What we've been seeing in the last 5, 6, 7, 8 years, even if we discount out what's happened with the COVID, is the belief that value is no longer of importance. What is of utmost importance is growth. In other words, I'd rather invest in a company that has tremendous potential of growth, even if I'm not even sure that ever make money, rather than invest in a company that's actually making money and is actually paying dividends. So what's been happening in the last 8 years, 9 years, 8, 7 years is the belief that value investing is no longer in favor and growth investing is become a lot in favor. And the problem with growth investing is that it's something that fits into itself. The more you invest in growth investing companies, the more they become growth oriented, and the more they become growth oriented, the more people put money into it, and it becomes a circle. And this company tend to outperform the market to the extent that you will never see and has never seen before in the value tranche of the market.
What do you think is driving that change?
Well, it's hard to tell. Obviously, the advance of technology, the GAFA, the Google, the Amazons, the Facebooks, and all those companies have shown so much potential for growth. But the problem is that these companies are actually making money. Well, maybe not right away, but at the end of the day, they made money. So the general sentiment to me seems that people are using these examples as the way it should be for all those type of growth company. Yep. The reality is that you only have very few companies that have this kind of growth, and at the end of the day, make a lot of money. Of course, you have Amazon. Of course, you have Apple, Facebook. They make tons of money. But we can talk about other companies who are completely it's distorted. Look at Tesla. Look at other type of companies. Why are they growing so fast? Why are they making so much money for the investors while themselves make no money? So that growth attitude is something that came about with the advent of very rich tech company. And as a matter of fact, when you look at the return on the market over the last few years, 80% of the top 80%, of the growth comes from maybe 10 companies. If you look at the NASDAQ, if you look at any of those, it's only very few companies that actually drive the market, and not, there is no depth. There's no depth into the value of the return on the company. Basically, if you invest in those 10 companies, it's enough. You don't need to invest in the entire Dow Jones or NASDAQ or whichever index you're looking at.
All right. I'll ask another question that really speaks about the growth. I'll ask about the Airbnb. As an investor, as a financial advisor, sorry, would you have advised me to invest in the company before the IPO, for example, knowing that they were losing money and with the COVID, almost lost the whole company basically? And I think like in January, Brian Chesky went on TV explaining that they almost lost it all if they hadn't changed something.
Well, I mean, Alex, I'm not sure I'm the right person to advise you on this, and I tell you why. Because I'm the kind of financial advisor who does not believe in home runs. I know this is an American terms, but maybe I'm sure everybody understands that. I'm going to hit one base at a time. Okay. And that's going to be maybe the case of other questions you might ask later on, and maybe the subject of the Bitcoin is going to come up. Maybe the subject of other things is going to come up. I'm maybe an old-fashioned type of financial advisor, but I believe that wealth is being generated over time, and investing in things like you just said is potentially interesting. But as a whole, would I put my entire money into this? I certainly wouldn't. Now, if I take 5% of my portfolio, if I take 5% of my assets and I decide to, quote unquote, play, why not? Yeah, I would have advised you to do that. Why not? But is it investing? I'm not sure.
All right. Okay. No, it's good. I'll ask that about the central banks, because what you said about the industries, some companies, if you have to understand where you're investing in, sometimes it's pretty difficult to understand what the central banks are doing, especially since the 2008. I think I'm old enough to say that I was enough intelligent to understand what was happening in 2008.
Not me, so that's good.
Good one. So we've seen so many countries going for the quantitative easing, from Japan, ECB, US.
Right.
Can you describe the role of a central bank?
Well, what's the role? What's the historical role of the central bank? The historical role of the central bank is to keep in check inflation, okay, and be the lender to other banks, and basically driving the rates of at which banks and ultimately businesses and consumers, individuals will borrow money. That's the historical job of a central bank. Then again, when they direct the interest rates for lending purposes, obviously, on the other hand, they will also direct interest rates for investment purposes. In other words, everything is being linked. If I drive my interest rate closer to zero as possible, it's going to be a boost to the economy. Everybody's going to be able to lend at a very, very cheap rate. But obviously, I will not get any return on my money if I just put it in the bank, because there is no such thing as positive return on money at the present time. So now let's talk a second about what's happened last year with the COVID, because if we go back to the question of today, which is why there are discrepancy between the two. To me, it's quite amazing that at the end of 2020, most markets, if not all markets, actually came out positive, while during the year, knowing the biggest pandemic the country has ever had, not the country, I'm sorry, the planet has ever known. And that's quite amazing. And going back to your question about the central bank, the only reason why it happened in 2020 is because of the central banks. The central banks in 2020 went way above and beyond their original role of keeping in check inflation, keeping in check the rates of interbank lending. They went way beyond that. Obviously, the first step, and not only they went way beyond that, but to me, what was even more remarkable was the speed at which they responded. Not only the central bank, but all governments. When you look at all the previous great crises, going back to 1929 and so on and so forth, did we get some kind of response from governments? Always. Did we get some kind of response from governments half an hour after it happened? Never. I mean, it's amazing how fast central banks, governments decided to engage in proactive actions within the markets to make sure that nothing catastrophic would happen. To me, that's really, really something that we had never seen before. And even more the fact that central banks went beyond and above their usual historical role, it's the speed at which they did. So again, they lowered the race to something which was close to zero, meaning that they allowed every potential businesses and individual to get free money. Okay, so obviously getting free money when you have the ability of going back to what I said, what's a business? The business is trying to make value out of something. So it's one of the things you have is free. It makes it easier to get value out of it. Okay, same thing. If your human resources is free, then it's much easier to make profit with cheap labor or zero cost labor. So again, same thing. I mean, zero cost of money makes it much easier to create profit out of that. But they went beyond that. There was a liquidity problem. One of the major problems we've had in end of March was a liquidity issue. All of a sudden, every outstanding assets couldn't find a counterparty. The central bank, especially in the US, became the counterparty for pretty much any treasury assets out there. They actually went out and bought themselves billions of treasury bonds, billions of mortgage-backed asset bonds. They actually were the buyer. They became the ultimate buyer for every assets out there. And that's something that we had ever seen, hardly ever seen before. So they allowed for a constant liquidity, and not only they allowed for a constant liquidity, but they also artificially allowed for maintaining a level of prices, which without them, we would have seen a major collapse, and not just a collapse, but we would have been collapsed and stay there. When you look at the rebound, the rebound went really quick. Yeah, we did get a rebound. And by the way, the crash was not just COVID related, it was also oil related. Okay, the one day where the market collapsed the most was not a COVID-related issue, it was an oil price issue. If you remember, at some point in the end of March, we had actually negative oil prices, something that we had never seen before. Okay, I didn't stay long, but we did have that. You could actually get paid to buy oil.
Yeah.
So what did the central banks? The central bank massively did that. They massively invested, and they massively gave money to actual companies. They went out and gave loans themselves to middle-sized companies in the US, for example, something they had never done before. So the central bank, this was definitely the key. The key was, we're going to take the rates to zero. In other words, money has no more cost. Okay, so that's an issue that they shouldn't have. We're going to make sure that the banks can keep on lending as much as need be, without having for them to go into their own reserves. So the central bank just kept on giving money to the bank. We had a liquidity issue. Not only we had a liquidity issue with treasury bonds, but we had a liquidity issue with corporate bonds. US central bank went out and bought treasury bonds. They bought mortgage-backed asset bonds, and they actually bought corporate bonds. They actually made a market for corporate bonds, something which is unheard of. So they kept afloat this whole market temporarily, and they're still doing it to this day, in order for the entire basically interactive markets all around the world to keep afloat. They also provided pretty much free dollars to the rest of the world, but they put in place currency swaps with all the European central banks, the Japanese banks, and so on and so forth. So by putting that in place, that allowed liquidity even to the European banks, which in turn could go and impact their local markets. So the role of first the Fed, the American central bank, and then the other central banks all around the world made it so that the market indeed did not only crash, but rebounded in some amazing ways.
Well, that's fair enough that we've seen a rapid rebound and that they have intervened more than they ever have before. But have they overstepped the mark? Because money is now, no cost. You could go into negative rates, but it's
we've seen that before.
Like, what do you do? Have we run out of tools? Like if this is just what the central bank does, if there's a problem, is this really a recovery or is it a synthesized recovery? It's not really what the economy is.
Well, my dear George, I think that the asset managers on this call, we are going to be hiring you because as you pointing out, if you have a great tool and you keep on using it and you keep on using it and you keep on using it, and at some point that tool is out of order and you don't have another tool, what do you do?
Oh.
Okay, so yeah, I tend to agree with you. Have we seen in the Western economies, what I mean by Western economies, the US and Europe, the extent to what the Feds can do? Are we at the end of a potential cycle? I tend to think so. When is it going to happen? I think you're going to ask me that in a few moments. But I'm not sure. But yeah, I think you're right. I think the tools that's been used by the Fed is not something that can be that can go on forever. Obviously, it's a bandage. Obviously, it's a huge bandage. I mean, it's a bandage to the size we've never seen before. But you're right, it is a bandage. At some point, and as I said prior, what's the real market versus the market economy? The real market needs to be making money. The real markets, the real economy needs to get back into shape without having a bloodline stuck into their arm and make money on their own. Going back to 2020 and the stock markets, I'm not sure that people know here in Europe, but in the US, the US government sent to every person a blind check of $1,500 without any knowledge of resources, needs, or anything. And while there is no direct studies that can prove this, there's a belief that one of the reasons the stock market went up is all these people who got $1,500 went out and bought stocks. And all of a sudden, you have a huge number of new, players in the stock market that didn't exist. And if you take 1,500 times how many checks they've sent out, which is billions, obviously, and we've seen this actually. We've seen a huge uptick in the numbers of quote unquote investors putting money into the stock market. So you get liquidity. When you think of it, all of us here. I'm not sure any of us had, on an individual basis, a liquidity issue. I mean, there have been so much money sent out by all the governments to keep everybody afloat. Would it be for unemployment services, big checks to companies, chômage partiel in France, where even if you had employees, you put them, and the government would pay their salary for many months. I mean, very few people actually had a major downturn in their own personal income. Again, in France, which are the number that I know the best, the level of savings in livret A and so on and so forth has never been that high ever. People are saving money like it's not possible. There's so much cash. There's a lot of cash. That cash now needs to go back and work. So I think that different countries have different issues, but the tools of the central banks is a bandage, a big one, I agree. At some point, it's not going to work anymore because
of course,
the real economy needs to get back into it.
Of course, but like you say, savings are high. People have got cash, like you alluded to, where I'm going. What does the future look like? Maybe, another year, 5 years, 10 years. Where's it? Did we ever recover from 2008? Is that partly why people are...
Well, you know what? Okay. we talked about that. Let me see if I can show you something quickly. Yeah, I'll show you this for a second, and then let me. I'm sorry. I just wanted to show you something that I'm going to share my screen here for a second. I'm sure everybody here has heard that, you know, if you put money in the stock market, you know, in the long run, you don't lose money. And I'm not talking about other countries, but I am in France, and, you know, the French market, obviously I have French clients. So a lot of time, you know, French clients are telling me, yeah, well, you know, I don't agree with you because the stock market is not that fantastic. And indeed, this is here a curve of the CAC 40 over the last 20 years. And indeed, when you look at 2008 here, or let's not do 2008 because we did recover from 2008, but even worse, let's say you were to invest in 2006 here, which was the highest the CAC 40 has ever been, okay? Mm-hmm. And you look 15 years later, today, okay? And you say, well, you know, today we're at 5,800. So, you know, we went from 6,100 to 5,800 in 15 years. So this is the reality that French investors look at, and they say, well, you know, here's the proof. Investing in the stock market is not a positive proposition. This is not something that I should be doing. Which brings me back to what I said earlier. What is a company? A company is an entity in which you put assets, you know, and let's go back to Marx for a second. You get three things, you know, capital, labor, and money. I mean, and goods, raw materials. So you put raw materials, you put labor, you put capital, you mix it, and at the end of the day, something comes out. And obviously, hopefully it's more than what you put in. So this is a CAC 40 over the last 20 years. And as I said, if you had invested in 06, you would have lost money today. So putting your money long-term in the stock market in France is not a positive proposition. But the problem with that is that it's completely wrong. And we are being lied to on a daily basis by the French markets. Because investing in a company, you invest in a company because you believe that company is going to make a profit. And because it's going to make a profit, the company is going to pay dividends. The CAC 40 is a reflection of the stock market that only shows the valuation of the stock price, does not take into account the dividends. If I look at the same chart over the last 20 years, but I take into account the dividends of the company, which is this one, look at the difference. It's phenomenal. If I had, this is 06, okay, this is today. Did I gain money or lose money between 06 and 2021? I mean, tons of money.
Charts haven't changed on our screen.
Oh, it hasn't. Oh, sorry. Let me do the new change. Here it is. How about now? Still not?
Nope.
You have to. That's right.
I know what to do. I know what to do. I just thought that I could do it faster. There you go. Good?
Still on the old one.
All right. So that's the chart with what it should be, which is I invest in a stock, I get the dividends, I reinvest the dividends, and it's what's happened at the end of 1, 10, 20 years. So the two charts, if I put them side to side, it's just, to me, it's an unbelievable difference. And the reason I'm showing this to you and to respond to your question is what's going to happen, you know, from now on. Again, I had the question. If I had the answer, I'd be on a sandy beach with a cocktail and potentially other things and enjoying my life. So I don't really have the answer. What I can tell you is that investing is not something that you do for 6 months or for 1 year. Investment is something that you do for 10, for 15, for 20 years, for a lifetime. And investing is not something that should take into account what happens in the market on a daily basis, even a year like 2020, when there is a major crash. Now, if I want to take more of a microeconomic vision of what's happened right now is that the stock market is a reflection of anticipation of what's going to happen. Most people right now anticipate that we are going to go out of the COVID-19, that the vaccine are doing the effect. And when we looked at the countries that have actually done well with the vaccine, best example on earth right now is Israel. the number of deaths, the number of sick people, the number of hospital beds, and so on and so forth is going way down, which gives everybody great hope that we are going to go back to a normal life within 6 to 12, 18 months. So if I were to predict, and again, please don't put the farm on it, but if I were to predict, I would think that 2021 will be again a positive year, because as everybody does not invest but speculate, unfortunately, speculation makes it so that we are hoping on a short-term basis that life is going to get better. So that's what I think is going to happen. On a, not a long-term, but a mid-term basis, in other words, 2 to 3 years, do I see the market keep on taking 10, 15, 20% a year? I really don't think so. I really don't think so. I think that at some point, just like George said, all the big bandages are going to really hurt when you take them out. And the economy, the real economy is going to get back in check with the market economy. And, you know, we will have a realignment of the stars. I truly believe that. So short term, yeah, I think most possibly people are going to be on good hopes that the vaccine is working, that the economy is back on track, and so on and so forth. But truthfully, we are, I think, at the end of a potential cycle. What is our chances of growing even more than what we have with the artificial money that the banks have been giving us, without the tools that the Feds have had? On a midterm basis, it's going to be difficult for the Western economy. Now, to also answer the question more specifically, obviously there are sectors which might be doing better than others. So what might happen is a sectorization of the markets. In other words, obviously the big tech companies, maybe it's going to be more difficult to sustain the capital growth they've been having. So maybe these are going to be out of favor. And I believe, because I'm an old fart, that value investing might come back into fashion. I believe that we've had a huge run on growth investing, and that it's now time, perhaps, for value investing to come back into play.
All right. So, Gerald, I'm going to ask you a question that's going to anger you.
No, it's all right. I don't get angry.
It is the eternal question that we all ask, and we've been asked, I think, at school. So I guess this one is really for my millennials and the Gen Z who will listen to this. Why do we invest? You know, with what you said about the 2020 market, we had the help of many trading apps, and nowadays a huge people are supposedly financial experts. What do you say as a difference, as speculation and investment, to these people who think Bitcoin is the way to go in the future, or GameStop, or I don't know?
Yeah, I see that Bruno is challenging me on Reddit and GameStop and so on and so forth. Thank you, Bruno. Yeah. I'll talk to you about that afterwards. Listen, you know, I'll tell you a funny, not a funny story, but in the building I work, you know, we have several stories, but we share like the same lunch area. And there is this young lady, 28, 29. She's got a small kid, 18 months, 2 years old, whatever. And she comes to me the other day and she said, "Oh, you know what I've done? I've decided to invest for the long term, so I just put money into the Bitcoin." So, and this was when the Bitcoin was at 50,000 euros. You know, obviously one Bitcoin. She didn't put 50,000. She bought 0.00012% of Bitcoins, but whatever. But what I found interesting in what she said was not that she believed in the Bitcoin. Why not? But she said in one sentence, "I'm investing for the long term into Bitcoins." How do these two go together? You know. So to answer your to get back to your question, investing is not speculating. Investing is something that you do on a disciplined manner with a time horizon of at least 10 years, 15 years. That's something that you do. You know, I was raised as a teenager and as a young professional in the US. And in the US, as a financial advisor, and I did that job as a financial advisor in the US as well, when you meet a potential client, you don't ask him the question, I'd like to become your financial advisor and help you, with your finances. The question you ask him is, who is your current financial advisor and how can I be better than him and win your business? Because the basic proposition in the US is that everybody has a financial advisor, and it is the truth. People at 10 years old, 15 years old, they start having a stock portfolio built by their parents, which they get at 18, and then do it themselves. And that's the mentality. We invest for the long term. Okay. I have a whole theory about the pressure of religion on how we save, but that's for another debate, Ian. Maybe I can comment on that at some point. But obviously, in the southern countries, in France, in Italy, in Spain, the culture that we don't save, we don't invest, we don't do this. But then when the market goes up, oh my God, yeah, I'm going to invest now, but it's too late. It's like having a beautiful pair of shoes in your favorite department stores, and you go on January 25th and it's 100 euros, and you go on February 15th and it's the same pair of shoes, but now it's on sale, it's 50 euros, and you say, well, I'm not going to buy it because it's cheaper. Well, yeah, you're going to buy it because it's cheaper. That's the whole point, okay? So when you like a company and now it goes down, nobody wants to buy it because it's cheaper. Well, it's the same company. And when it goes up, now it's expensive, everybody wants to buy it. Obviously, it's the wrong thing. So for me, investing is what? For me, investing, you've got, and it's a little early. It's only quarter of, but I'm still going to give you the secret of investing and becoming rich, if you don't mind.
Yes, please.
Okay, sure. So follow my lead. It's very important. There are three tenets to becoming rich in investments. The first one is obviously time horizon. If for you investing is a 6-month, deal, then it's not investing. Time horizon is 10, 15 years. Retirement. I'm 25 years old. At 50, I want to buy the biggest yacht on earth. That's investment. Okay, so time horizon, number one. Number two, diversification. Should I put all my money into Airbnb? No. Okay, so you need to diversify. And it's very easy nowadays to diversify, even with 500 euros, 1,000 euros. It's no big deal. It's really easy. It's not an issue. And the third thing, is disciplined investment. You have to be disciplined about it. Every month you put a percentage of your net income towards your investment fund, and you don't budge from it. Yeah. And if you get a raise in your company, then you take the same percentage and you increase how much you put every month on your investment portfolio. If you do those three things, and it sounds so stupid that nobody does it, but if you do those three things, I guarantee you, you will maybe not become rich, but you will increase significantly your wealth. There's one reason why Albert Einstein said that the only thing that still amazed him was the effect of compound interest on a portfolio. Yeah. The guy could basically understand everything on earth, and the only thing that amazed him was compound interest. And the reality of the financial advisory world is that it is not complicated. Okay. Now, should you get a financial advisor to do a better job at investing? Obviously, I think so. That's my job. Do you get better results when you a high-level athlete by having a great coach next to you, or do you go out and train by yourself? Do you when you really want to lose some weight or get in shape, do you do it by yourself or do you get a coach? I mean, having somebody whose profession it is to help you in a particular field, to me, that's how to do it. But the truth of the matter, and I shouldn't be saying that, but the truth of the matter, it is not that complicated. Investing is not that complicated. The problem is that there's so much noise there's so much pollution in our daily lives. When I mean pollution, I mean the media and you know, the again, you know, with, you know, Bruno is talking about GameStop, and obviously you're gonna have some scams. Obviously you're gonna have some problem. You know, we had GameStop in 2020, but in early 2000 we had Exxon. You know, we had, I mean, you always have problems. You know, you're gonna have, always gonna have. That's the purpose of diversification. That's why you diversify. Okay, if you buy a bond portfolio with 50 different, if you buy a bond portfolio with 50 different bonds in it, and one goes south and goes out of business, okay, it went out of business, but you still have 49 of them.
Yeah.
If you had just bought that one and went out of business, then you lost everything. So financial advisory is not a complicated job. What's complicated is the psychological job that we have to do on a daily basis to explain that to people.
All right.
Good. Right. I mean, there are interesting questions coming into the chat, so I think it's time that some people challenged you with questions that you didn't know were coming.
I think it's time for me to go. Thank you very much. It's been a great pleasure.
So can I perhaps George start off? Is that okay?
Go for it.
So the big question, I think, the underlying question is, given QE and given that central banks are pumping liquidity into the economy, is investing and our markets now a one-way game? There's no risk of losing, because over time, if you know, the big investment houses know that they can buy stock, and if the markets go down, or if there's some kind of dreadful correction, that the state will continue to pump liquidity in. So that's the first question. So is it a one-way game now? And then what's the moral hazard around that? What's the problem around that? And then I think a second question around that is, what about inequality? You know, if people who've already been in the markets and have been in the markets over a long period of time are on this one-way ticket, what about the rest of us? What about people, you know, who are just starting out and who don't have the funds that they've already built up and don't have the possibility to get into these markets that have already been pumped high by QE and money coming in from the central banks and governments?
Okay. Well, you know, your question basically, I think I've already touched on some of the points, but, you know, you rephrasing a little bit differently. But, you know, from what I understand, you're telling me is, am I at risk because the central banks have done what they've done right now to invest now and lose money, you know, and soon? As I said, yeah, I think that, you know, short term, maybe not, but midterm, at some point, there will be a correction in the market. And yes, I do believe that when the central bank will stop using the tools, or even if they keep on using the tools, at some point the tools will be, these tools will be ineffective in essence, because we would have run out of effectiveness of these particular tools. Yeah. So on a midterm basis, am I at risk to see my portfolio decrease in value? Most definitely, most definitely. But again, if my time horizon is 15 years from now, and in 3 years from now, I have a downturn in the market, why is that a problem? If you have a house in which you live and it's your home, and you keep on living in that home for 50 years, and at some point during the 50 years, the real estate market has dramatically collapsed, how does it matter to you? You still live in your house. It doesn't really matter. And obviously, if you are in the market, if you are present and have funds into the stock market, it is because you don't need the money on a short-term basis. That's what needs to be understood very clearly. If you are in the stock market 100% or partially, it is because you don't need the money in 6 months, in a year, in 2 years. Because if you do need any of that money in the next 6 months to 2 years, then you should take out your money in the stock market and put it in other type of assets.
Yeah.
Okay. So again, are we at risk? Yes, but at risk of what? Of having my portfolio paper loss on my statement at the end of the year, yeah, I'm at risk at that. But if I'm in the market for the right reason, I shouldn't care about that. And if I apply the strategy, which is to have a disciplined approach to investing, the day that the market will fall, and eventually they will fall, then I'll go in at a cheaper price. So it's a great opportunity. Each time the market goes down, I feel like I'm at, I was about to say, Bloomingdale's, but that's not in France, Printemps or whatever. And it's everything is on sale. It's fantastic.
Yeah.
And the reason why I'm saying that is because the clients to which I advise to be in the stock markets, and obviously I have a lot of them, they don't need the money tomorrow. They're not retiring in 6 months. All my clients, 100% of my clients who are within 3 to 5 years of retiring have little, if no money in the stock market.
Okay. Looking at the chat, I think it would be.
Let me respond to the second question, which is it too late to get in? I believe you asked that question, Ian.
Sorry, I could get my microphone back on. What I was really driving at is, if the central banks are always going to provide a backstop to the markets, okay, are they a market still?
Good. Okay, I see what you mean.
And what opportunities are there for people who haven't already built wealth? What I'm driving at really is, if
it's an unfair game, basically.
Central banks, the game is rigged,
right,
and therefore people who've already built wealth have an unfair advantage.
Okay, I see what you're saying. What's happened in 2020 is certainly unfair, but at the same time, did we, or did the central banks or governments have any other choice? Should they have left the markets collapsed? Maybe not. So I believe that the whole idea of market intervention, of central banks intervention and government intervention is, as I said, allow time to come back for the real economy to take over and start making money again. That's what it is.
Yeah.
Obviously, if the strategy is to keep on pouring money indefinitely into the markets, we have a problem. We have a problem because it's not sustainable. What sustains an economy is for the businesses of that economy to create value. We can't get away from that. Value creation is what it is. I mean, if an economy is not capable of creating value, then there is no such thing as an economy. So has the central bank done an unfair job of keeping the markets up? Yes. Was it necessary? Absolutely. Should they keep on doing so? Yes, but not for long. They need now to allow for the economy to recover the ability to create value.
And there's a very interesting sort of relationship with the check that the US government sent to everyone. So $1,500 check that they cut for everybody. And a lot of that actually went back into the market. So even if we're talking about perhaps putting helicopter money into the hands of everyday people, then maybe they don't spend it in the real economy either, and maybe they just go straight to the market for some of those funds.
It depends where.
Quite interesting.
It depends where. Do that in France, people will put in their livret A.
Yep.
That's the problem. That's the main problem we have in France. The main problem we have in France is that, let me tell you one thing. If tomorrow 10%, 15% of the liquidity in France were just to go into the stock market, just that would drive up the stock market 20%, 15%. I don't know.
I think we need to, just for audience who are not in France, just point out what a livret A is. So a livret
I'm sorry, it's just a basic savings account.
Basic savings account, yeah.
Yeah, basic savings accounts. But the problem, my own children, my son lives, my children live in the United States, in Los Angeles area. And, the other day he tells me, oh, by the way, I forgot to tell you, I opened up a stock account. I'm like, whoa, wow. The artist did not take after me, took after their mother. I said, I'm like, wow, congratulations. It's like, what made you decide to open up a stock account? He goes, well, I just got $1,500 in the mail. And so I opened up a stock. There you go. Mm-hmm. He never even had a savings account.
Yeah.
So Bruno Argentieri has asked about Reddit.
Don't listen to him. Frankly, I know the guy, and
maybe Bruno can come on one day as well. I've sent him an invitation on LinkedIn. We'll have him on to do a subject. Can we put that question to you?
Sure.
What do you think about Reddit, GameStop?
What I think of crooks crooking the system, put them in jail. What can I tell you?
I think maybe the second point that Bruno put in the chat is interesting about risk, because the two are probably related. Attitudes to risk and people that are likely to jump on a trend like that, is that varied around the world? Is it, was GameStop a thing in France particularly, or is this an American British problem?
I think crooks is an international problem. The central idea of risk is that the more risk you take in the stock market. What's the saying? The saying is that the more risk you take, the more potential reward you will have. Okay. Another way that portfolio manager describe risk is volatility. In other words, the more volatility you have, in other words, the more movement there is between the high and the lows of any particular stock or funds or market is equal to whatever risk you might take. And why is that? Because at any time that you need or must go out, you might be in a downturn, and hence you will lose money. Goes back to, if I need the money in 6 months from now, I should be in there in the first place.
But doesn't this come back to the whole point that we're exploring about the unequal sharing of risk? This whole GameStop thing, that small investors are called crooks when they try and game the system, but then the larger hedge funds who have got the system pretty well organized to how they would, how they would like it, and who get the regulatory authorities coming to their rescue when something doesn't go their way. I mean, who are the crooks in all this? Who are the, perhaps the system needs to be changed, and perhaps this is a wake-up call. What do you think?
Well, here's what I think, Ian. I think that given the amount of hair you have on your head, I would not have had expected this question from you, but more from George or Alexander. And that's because, life will tell you that it isn't fair. And, you don't believe that when you're in the 20s, but when you start having less and less hair on your head, then you start to realize that it isn't fair. So who are the crooks? Yeah, what's the greater good? Is it more important for banks not to fail even if they are crooks than it is important for them to fail because they are crooks? I don't have the answer to that question.
Mm-hmm, mm-hmm.
I mean, it's an ethical question.
My serious point is, obviously everybody knows that life is, well, obviously, mainly people know that life isn't always fair. But my more serious point is, if you believe in markets, and if you believe that markets are a great thing, and I think the consensus among most of us is that the markets do have a use, surely they've got to work, and surely they've got to be seen to be relatively fair to everybody for people to get involved.
You know what? There's a famous French singer a famous French, how you call that, social media star that says, "La question est vite répondue," and you just did. You said, you said, don't we need to have a system which is generally fair? The most important word in that is generally. As long as it's generally fair, then it's okay. If it's going to be 100% fair, it's never going to be. Are we going to have 100% free market with all the right forces driving each other to be able to get the right? No, it's not going to happen. But if this works at 90%, good enough.
Yeah. Yeah.
All right. So
I mean, it's a little bit cynical, and I understand that, but it is what it is. I mean, all the huge instances have a direct line with the CEO of the CAC 40, Dow Jones, DAX, FTSE companies. Yeah. Do we have that access? No. Is it fair? No. Is it the way it is? Yeah.
So, George, can you see the question about inflation there? Do you want to take that, Alex?
Yeah. So, Well, the question is, what are your thoughts on the risk of hyperinflation once the economy starts functioning again? Will all the money people have been saving, you referred to earlier, be suddenly splashed on restaurants and cinemas and holidays when people are again able to go out and spend it? Will prices soar, and do we need to protect ourselves? Good question.
Well, you should always protect yourself to start with. That's important. Okay, well, that question is interesting for two reasons. The first one is, one thing we didn't talk about is another reason why the stock market has soared is because there is no inflation, or very little, and there is no rate of return on bonds, or treasury bonds, corporate bonds, or it's very low. So for most investors, basically you have no choice but to go to the stock market because there is no alternative to investing in bonds. In other words, if I'm a huge fund, retirement fund, and I run the New York State Retirement Fund or the California State Retirement Fund, I need to go somewhere because my entire actuary of repayments of my retirement payments to my ex-employees is based on a rate of return that I need to achieve to be able to keep afloat my retirement fund. If I go and put my money in treasury bonds and I get zero or negative return of absolutely no return, where do all this money go? All this money will go into the stock market because there is no other choice. Okay. So that's another reason why there's so much money going into the stock market. Now, the Fed chairman just said a couple of days ago that he will not foresee, increasing the rates in the U.S. and that he will do anything he can to keep it at close to zero, and he does not even have a horizon as to when he's going to increase the rates. So are we looking at a rather mid to long-term stability in rates? I think so. Are we looking at a potential inflation risk? I think so too. At some point, it's going to happen. But is inflation a bad thing? Most of you guys are way too young to remember. But when we had we used to have inflation in the 4% and the 5% and the 6% a year, and believe it or not, most people were happier at that time because they would put their money in the savings accounts and they would get a 5% rate of return, even though the inflation was at 6%. But they thought, hey, oh my God, I'm getting 5% risk-free money. They didn't really look that inflation was at 6%, but they really thought that 5% risk-free money was fantastic. Okay, so a little bit of inflation is not a big deal. To the contrary, are we going to see the wheel turn too fast, burning itself and having a risk of really high inflation? Personally, I don't think so. I don't see it happening because the economy is not here right now. Even in the emerging market, we didn't talk about spreading your risk to different markets, but even the emerging markets, China had a risk of inflation. What just happened with the COVID and so on and so forth tempered that risk. And actually, if I were to put any money right now as a diversification, I certainly would consider China as a great potential for future upswing.
All right. I think it'll be all for today's questions, but and we'll have to agree that it's a question of generations as well.
Yes, it is.
For the GameStop Reddit, I was all for it. It's like George, we were on the same path, and
yeah, I mean, I was for it as well. But there's a saying in French, je vais aller jouer en bourse. I'm going to play in the stock market. Mm-hmm. It's such a bad word. You don't play the stock market. It is not a game area.
I think some people do.
But if you do, then you speculate. And if you speculate, you're going to lose money or not. But you understand, as long as you understand that speculation means potentially losing money, then you're fine. I don't have a problem with speculation. I think speculation is fantastic. Speculation brings liquidity to the markets. It's a great thing, as long as you know that you are speculating.
All right. So we'll end up with this. Thank you, Gerald, for your time and speaking to us for more than an hour, actually. We appreciate that. And for everyone who took the time to stay on, it's 2 p.m. in France. And yeah, thank you for
time for coffee.
Time for coffee, that it is, and cigarettes.
Thank you very much.
You're welcome. Thank you for very much for Gerald and George, my co-host, of course, and thank you for the whole team.
Thank you to Future of Money for allowing me to be here today.
That's awesome. So I'm thinking about Mywen, Ian, and Adam for the work done behind the scenes, and thank you for the sponsors as well and promoters, Sencheng Digital and Toulouse Business Exchange. If you're watching this on YouTube, please give us a like, a comment, and subscribe to the channel. Another thing is to invite people who are on social media as well, Instagram, Facebook, Twitter, and LinkedIn, well, everywhere, basically. We have all the links available and on our platforms and obviously on YouTube as well. So please share our future events and well, glad to see you next month. Thank you all and have a great day.